Okay, today's bank is Univest Financial Corporation. They're based in Pennsylvania. Um, and they also, besides being a community bank, they've also got insurance and a broker dealer, advisory, wealth management type stuff as well. So they do a lot of things. And if we look over at the Yahoo Finance page, we can see their market cap's about 668 million. That's a little bit on the small side, at least for the publicly traded community banks in our population. So smaller bank, but we can see here that with the trajectory of the price, most of the banks that we have in our population kind of did an up and down, and they're kind of at the bottom of their pretty consistent with where they were last year or last fall. But this bank has really had an uptick over the past year. We bought it I think about a year ago, and it's up around 30% since then. So it's been a really good performing bank. It'll be interesting to see once we dive in if it's still a good value to buy. Currently, it's got a price earnings ratio of about 9.5, so that works out to about a 10.5% earnings yield. So that's pretty good. It's about average, I think, for most banks right now. So it's good to see that in the range. Pretty good dividend yield as well. If we come over to the statistics, we can see some of the other valuation metrics. So price to book's a little bit on the lower end of where we normally see, so that's good. So it seems like the price for the earnings and the price for the net assets might be pretty reasonable price. If we look at the return on assets, return on equity, these are also within the average range that we look for. So return on assets is usually somewhere between 0.9 and 1.10%. So it's on the lower end of the range, but it's within the range. Return on equity as well, 8.57%. It's a little bit below the range of where we normally see it, but perhaps it's got a pretty average reasonable profitability, average reasonable price. So let's dive in and see what they're all about. So looking at the balance sheet, they've got about 200 million of cash, about the same amount of held to maturity and available for sale securities. So these amounts are really small compared to the assets as a whole in relation to most banks. It ends up being, these liquid assets, cash plus, available for sale securities would be about 4.5% or so of the assets. So that's a really tight liquidity position. Just looking at this, most banks we look at might be somewhere between 13 and 20% of their assets being in these liquid forms, cash, available for sale securities. But these guys are maybe a third or a fourth of that. So keep that in mind once we consider the liquidity position in more detail later on. So, and then, looking at the loans, we've got about a little over 6.5 billion. That's about 85% of the assets. That's a lot as well. Usually we see somewhere between 68 and 74%. So they're really heavily weighted toward loans, and of course that's more risk than if they were weighted toward securities or cash. But it's also perhaps a higher yield on the earning asset. A typical measure of leverage that investors typically look at with banks would be the loans to deposits. And in this case, it's about 102%. So this 6.5 divided by 6.4, which is actually a pretty high percentage. we usually see somewhere between 85 to 90%, something like that. So these guys being over 100%, pretty leveraged toward loans, and so we'll be able to see a little bit of the effects of that once we kind of dig into the loan portfolio as well as kind of the income statement. The rest of the assets are pretty customary. A little bit of goodwill, some life insurance, stuff like that. So not that unusual here. So I would suspect that if we're a lot more heavily weighted toward loans than securities and cash, we might expect to see a little bit higher interest income on the income statement. But we'll see if that transpires. So now looking at the liability side, we've got $6.4 billion of deposits, and those are lower costing sources of funds, and then they've got a little bit of debt. So long-term debt, $250 million. I believe that's mostly FHLB borrowings, and some subordinated notes, some fixed to floating notes here. And then I believe these are repurchase agreements. It's 4.8, but we can make sure once we dive in a little bit further. But so total deposits is about 92% of the liabilities. That's pretty normal, and actually maybe on the higher end of most banks. So that's good because those are the lower cost side. They also have about 20% of the liabilities are non-interest bearing, which is that's in the average. It's in the range of the average bank. So it's about normal. We normally see somewhere between 20 and 24% non-interest bearing. So we like to see as much non-interest bearing liabilities as possible because cheaper source of funds. So anyway, this liability side of the balance sheet is pretty average as well. They do have a little bit less debt than the average bank in favor of a little bit more of interest-bearing deposits. So maybe that provides them a little bit cheaper source of funds than what the deposits do. So all in all, this assets to equity puts them at about a 9 times leverage, which is below the average range for most banks. So they've got they're a little bit less leveraged than most banks, but they are a little bit more allocated toward loans. So maybe that kind of evens things out from a risk perspective, and also maybe a return perspective as well. All right, so let's go down to the income statement, and we can see if any of that turned out to be correct. So we've got $98.6 million of interest income, coming from the loans and securities and invested cash and dividends and such. And that ends up being about 5.47% of assets. So that's on the higher end of the range for most banks. So they are earning a good amount of interest income, and like we talked about, it's probably because they're a little bit more allocated toward loans than most banks are. So earning a little bit higher yield, and we'll be able to see that too once we get into the MD&A of whether what that yield has been over the past quarter. But yeah, somewhere around 5.5% yield on the loans, or on the assets, which is a really good yield. So coming down to the interest expense, $47 million. That's about 2.77%, and that's a little bit higher than our average in our population as well. So their deposits and debt is high, yielding higher than the average bank as well. So they've got higher yielding assets, but also higher yielding liabilities. So it puts them at a $51 million net interest, which is about 2.65%. So that's on the low end as well. We normally look to see somewhere around 2.8 to 3.2. So a 2.65% net interest income is pretty low. at least compared to what we see for the average bank. But I think the big benefit to the bank, I think, is that they've got several sources of non-interest income. We talked about, they've got an insurance company, they've got investment advisory, trust fee income. So they've got a lot of different sources of revenue outside of just commercial banking, which really adds to their bottom line. So this is a little over 25 million. So that's 21% of the revenue comes from non-interest income sources, which is really, really good. It's basically about double of what we would see for the average bank. Average bank, somewhere between 10 and 14% of the revenue comes from non-interest income. So these guys are doing a really good job of getting extra money from other sources. And so, more than likely that's going to require them to have to spend more in expenses as well to get this extra income. So we can see how that affects. So I can see that, 50 million is the non-interest expense, and that's about 40% of revenue, which is actually really low. We see somewhere between 42 and 47 in most cases percent of revenue that is the non-interest expense. So these guys being at 40%, not only are their non-interest income basically double of what the average bank is, but they also have less non-interest expense. So, even though they're making a little bit less on net interest income, which is kind of the core of the company, they're adding a lot of income just from providing these ancillary services and then kind of keeping their costs down. And so all that together comes to about $20 million of net income, and that's about 1.03% return on assets, and that's awesome. That's basically the average, right in the middle of the average spread that we might see for return on assets for most banks right now. So, right around 1% is a good average profitability for a bank. So, all that together, I feel like that's a good profitability. If we were to compare it to the market cap of the company, we would see that it's about a 12% earnings yield. So if you were to buy the company at its current market price, the earnings here are about 12% of the price you pay, and so that's above the normal range that we might see. We normally look to earn at least like 9.5 to 11.5% earnings yield, but this bank is earning about 12%. So the value that you get out of these earnings seems to be higher than the average bank. So. But, so that's just the profitability standpoint. Once we dive into the footnotes and the MD&A, we'll be able to tell, what the risks are for those earnings and for that value, and determine whether that would be a good price to pay. So we go down to the footnotes, kind of skip through all of the accounting policies. So the first footnote, investment securities, as is usually the case for most banks. We've got the held to maturity securities as well as available for sale. And you'll notice that, just like most banks, most of their securities are mortgage-backed or collateralized mortgage obligations. So they've got 1.9 million plus 264 million plus 124 million. So about 82% of their securities are mortgage-backed, or at least some kind of asset-backed, and come with the implicit or explicit guarantee from the U.S. government. So their security portfolio is relatively low risk, presumably. The risk that we do have is that it looks like most of the securities are older than 10 years, or at least mature longer than 10 years from now. So that could be a risk from interest rate risk perspective. If interest rates were to go up, we're still trapped into these securities earning these yields, these lower yields than perhaps what historical yields are for these types of securities. As we saw, the securities only represent about 5 or 6% of the assets on the balance sheet, so it's not really a hugely material part of our analysis. Most of the assets of the balance sheet, like 85%, are loans, so we really want to spend a lot more of our time and analysis in the loans. I feel like the securities have not only a fairly low risk, but also pretty low effect on the balance sheet or income statement relative to what the loans do. So here's the loans. Most of them are commercial real estate, so about 50% of the portfolio is commercial real estate. Here, this $3.3 billion. It's a little bit on the high end on allocations to the different types of loans. They've also got a lot of residential real estate, which is about 22% of the loan portfolio, and that's pretty average for the community banks that we have in our population. So a little bit more weighted toward commercial real estate, a little bit more so than most banks. So maybe that's why they're able to earn a little bit higher yield on their assets and loans than what most banks are. That comes with its own risk as well. So we'll be able to look a little bit into the credit risk as well, diving into these footnotes. So past due loans. If we were to look at the accruing past due loans, 17.2, plus the non-accrual loans, so 17.2 plus 20.3, that gets us about 37.6 million past due loans. That's about 0.57%. That's kind of on the low end of the range that we look for. We're usually looking for somewhere between 0.5 and 0.8. So, being 0.57% of loans, that's pretty on the low end. Non-accrual loans of 20.4. That's about 0.31%, which is also on the low end. We usually look for somewhere between 0.3 and 0.5%. So they've got a lot less, or they're on the lower end of what the average bank has as far as past dues and non-accruals. So that means that but maybe the credit quality of the loans in their portfolio is sound. And as far as the non-performing loans go, non-performing would be the non-accrual plus the 90 days or more past due, still accruing, plus any OREO, so other real estate owned, is basically what they've foreclosed on. So that plus that, the non-accrual plus the 90 days and still accruing, plus about 19 million of OREO that they have on their balance sheet, gets them about 40 million of non-performing assets, and that's about 0.61% of assets as well. So that's in the range of what a normal bank has as well. So really, just looking at the metrics, the credit quality is about average for compared to the average bank, or if maybe even a little bit on the low end compared to or credit quality is a little bit superior than the average bank perhaps. And so the big metric that we normally look at, so let's look at the collateral dependent as well. So collateral dependent is about 20.4 million, it looks like, and that's about normal as well, 0.31%. We normally see somewhere between 0.3 and 0.5, so 0.31% is a very average amount of collateral dependent loans. So the big thing that we look at is the classified loans, which would be ones that are ranked as substandard or worse. And So we've got the C&I here, which is 17.5 million plus the 11 million plus the 26 million, and so on and so forth. This is from the commercial side, and if we skip down a little bit, there will be more from the consumer side, but not as much. So if we were to add up all the classified loans, it comes to 62.7 million. That's about 0.95%, and that's below what we would normally see. The average bank normally has about 1.1 through 1.65% of its loans being classified. So this bank's loans has a lot less that are classified, so maybe a bit higher credit quality, and that corroborates a little bit of what we saw. Less past dues, less non-accruals, so maybe a really sound loan portfolio here. And the next thing we look at is what is the actual accrual that they've made, or the reserve that they've made for loan losses, and that comes to 85.6 million, and that is about 1.3% of loans, which is a really high reserve. So normally we see somewhere between like 1.10, 1.3% of their reserve or of their loans being reserved for. So these guys have reserved 1.3, which is a little bit higher. So not only is their credit quality, the risk in their loan portfolio lower, but they've also reserved a whole lot more, not a whole lot more, but they've reserved more of those loans than the average bank would have in these circumstances. So I feel really good about the credit quality. And that they're being fairly conservative with their reserve. So if in the future there were some some loans that deteriorated, they would perhaps have enough of a reserve in place to offset it to where it doesn't affect the income statement. So anyway, all that to say, it's a really great. Lower credit risk than the average bank, I feel like. So moving along, kind of skip over some of the stuff that we've already talked about. So here's we were right. So the 4.8 is repurchase agreements with the customers. 250 million of the debt is FHLB advances, and then almost 150 million is subordinated notes. And I had to look at the 10K to see what's going on here, but there were two separate notes here, 100 million and one that's 50 million. I think, if I remember right, this is a the 100 million note reprices in 2025, or at least it converts to floating in 2025, and the $50 million note converts to floating in 2027. So both of them, all of this reprices within the next 5 years, but after 1 year. So, which is fairly common to see. And FHLB advances, so 25 million reprice this year, and then the rest of them sometime in the next 5 years. So most all their debt reprices after the first year. So that's a pretty good interest rate risk setup. So we don't have to worry about interest expense related to these going up until several years from now. And on top of this, they've got the ability to borrow from the FHLB and the Federal Reserve. They've got 3.2 billion that is their borrowing capacity, but they've actually got a lot of letters of credit outstanding with the FHLB as well, which cuts down on their borrowing capacity. So it's actually 3.2 minus 1.1, so about 2.1 billion that they can they can borrow minus the 250 that they've got outstanding as well. So, they've got about a $3.2 billion capacity, but actually they've used a lot of that to where they've actually only got about 1.9 billion available to borrow, at least based on the collateral that they put in. But once we get into the liquidity and capital, we can kind of dive into a little bit more of what that means for the bank. But just some things to think about there. Anyway, so retirement plans, stock-based comp, those plans and policies were pretty right down the fairway for what most banks have in place. The outstanding unvested units aren't that too far outside or aren't outside the norm. So derivatives, they've got $250 million of cash flow hedges that hedge the variable rate loans. That's something that I don't like, because what I'm wanting is, as interest rates go up, they earn more interest on the loans, right? So they're basically capping their interest they can earn on these loans, or at least 250 million of them. But they've got 6.5 billion loans, so maybe it's not that big of an effect. But I like to see the cash flow hedges be on the liability side to cap the interest expense as opposed to interest income. But we'll look at the call report to see kind of how and add these hedges in there to make sure what is the timing of the assets and liabilities, and how does that affect potential interest rate risk. Anyways, kind of going through that fast. So we've got the fair value disclosures here as well, and so some of the things on the balance sheet are at historical amortized cost. So this footnote helps us understand what is the actual fair value of the things on the balance sheet. So held to maturity securities are at amortized cost on the balance sheet, as is loans. So you can see there's a difference of fair value versus carrying value here. So if we subtract these out and adjust, also the mortgage servicing rights usually have a higher fair value than the carrying value on the balance sheet. So if we were to convert these to fair value, we would have to reduce the assets by about 91 million. Yep. So about 20 million minus 75. Yeah. So about $91 million difference, which is only about 10% of the equity that's on the balance sheet now. So really converting to fair value doesn't change, price to book ratios and all that much, And so it's the same thing on the liability side. The time deposits could have a little bit of a fair value difference. And so the 1386 minus 1392, so that's only like an $8 million difference. Sorry, maybe like 5 or 6 million. And then some of the debt is a little bit different as well, especially the subordinated notes. So about an $8 million difference there. So all in all, if we were to convert the balance sheet to fair value of net assets, we have to reduce the equity by about 10%. And that's actually a really small amount. So the fair value of the net assets isn't that much different than what is on the balance sheet. And because normally we would see somewhere between 25 to 40% reduction in equity on the balance sheet to get it to fair value, but these guys only have to reduce it by about 10%. So, from a valuation perspective, if we were to compare the fair value of the net assets on the balance sheet, like after we convert them to fair value, if we compare that to the market price, that's about a 1.15 times price, which is really, really cheap for the net assets of a bank right now. Normally we would see somewhere between like 1.5, 2.5. So if we were to buy the bank at the current price, we would be buying these net assets at 1.15 times their fair value. And that's super, super cheap. Also from a capital adequacy standpoint, if we converted the assets and liabilities to fair value and compared the net, assets minus liabilities, the net assets, the fair value of those, compare that to the fair value of its assets, that ratio is about 8%. So which is also a really high percentage. For a lot of the banks, we see it's somewhere between 5 and 7% that the net assets as a percentage of the assets is. So it seems from a fair value perspective, these guys are really, really, really well capitalized compared to most banks. But then also from a value perspective, the market price for these net assets is really, really cheap. So that's awesome. So let's see. So far, looking at the valuation of the bank as well as the profitability, it seems like it's a pretty good, well-run bank at a reasonable price. But we still got a little bit of analysis to go. So let's make sure that that's the case. Yeah. So you can see the banking gets them about 20 million, wealth management a little over $1 million, insurance a little over 2 million. So having these other segments adds about 3.5 million to their bottom line, which is actually another 17.5%. So as we saw that they might not make as much on the banking side, the net interest income side, but adding in these other services adds almost 20% to the bottom line, which is really helps them out. All right, so we're getting into the MD&A, which we can see a lot of the statistics that we've already looked at. So return on assets 1.06%, return on equity 9.69%. As we talked about, these are pretty average, right down the fairway for what most banks are currently. From the net asset or the yields side, so we can see what each of the different assets and liability types yield. As we saw earlier, 5.49% interest on the earning assets, but the liabilities are really expensive as well. So those kind of counteract and put them at a pretty low net interest margin of 2.88%. So I'll be interested to see. As we talked about, the net interest margin, we're looking for at least somewhere between 3 and 3.5. So it's a little bit on the lower end. But as far as the asset side of things, be interested to see, because this 5.49 is a little bit higher than what the average bank is. So we got loans at about 5.68%. Normally we see somewhere between 5 and 6, so that 5.68 is kind of right down the middle. Yeah, and so securities and are earning somewhere around almost 3%. That's pretty average as well. Yield on the cash that they have is a little bit on the higher end, but also pretty average as well. So really this 5.49%, that's a little bit on the higher end of what most banks are, but fairly run-of-the-mill yield on the asset side. But the liability side seems really expensive, so 3.5%. The subordinated notes is about average right now, 6.16%. Normally we'll see somewhere between 5.5 and 6.5%, so that's about average. FHLB advances, that's about average as well, or maybe actually even on the lower end. We usually see somewhere between 4 and 5, so a little bit on the lower end. So really, I think what's so expensive is the deposit side, at least relative to what the average bank is. So time deposits 4.42. Most of the banks we see somewhere between 3 and 3.5% of time deposits for this quarter. 4.42%, that's pretty high. And And then also, some of the interest-bearing core deposits, we might call them, up to 4.5% for money market. And so we would normally see 1.5 to 2% for these. So it seems like the deposit side for them is really, really expensive compared to most banks, and I guess that's what's causing this the total 3.5% yield to be really high and really eat into their margin. So ouch. And so on top of that, as we talked about, a lot of their, they have maybe 20% of their deposit or 20% of their liabilities into non-interest bearing deposits, which is great. But they most of the rest of the liability side is earning deposits here, which don't have that much lower of a cost than do FHLB advances. So it almost seems like it might benefit them to utilize FHLB rather than its depositors. But they know more about the insides of their customers and the rates that they can get for different things than I do. But it is interesting that the deposits are creeping up on the average rates for the FHLB deposits. That's pretty uncommon. So anyway, yeah, that's why we've got such a low net interest income. That's unfortunate, but fortunately we've got a lot of non-interest income, as we talked about, and non-interest expense, or lower non-interest expense, so that helps us to make a little bit more money. But yeah, so non-interest income here of 25 million, non-interest expense 50 million. Not too bad. So I'm going to skip through some of the financial position part, since we kind of went through that in detail due to the footnotes. We scroll on down. So here's the capital adequacy side. So we can talk a little bit about the capital of the bank. So we've got, as of the end of March 2024, the capital ratios here, about 9.5%, 10.5%, 14%. So these are all pretty low. They're below the range of what the normal bank has, which isn't necessarily bad. I mean, they're above the regulatory requirements for being well capitalized. In some cases almost double that. 10 versus 5, 11 versus 6.5. So but they are a little bit less capitalized than other banks, according to at least risk-adjusted side. And that might be due to them having a higher amount of commercial real estate loans than what other banks do, but also being more highly leveraged toward loans. As we talked about, there's 85% of their assets are loans, over 100% loans to deposits, so that kind of eats into these ratios as well. That gives us a window to talk about the liquidity as well, as well as the overall capital. We talked about the liquidity earlier when we were looking at the balance sheet. But they've got about 200 million of cash, which is a really, really small amount. Given the size of their balance sheet, I think it's about 2.5% of the assets. So that's a really, really small amount. And then their next item of liquid assets would be unencumbered securities, which they also have a really small amount. Essentially, all of their securities have been pledged either to depositors or to FHLB or Federal Reserve. So they basically have no unencumbered securities. So the only on balance sheet liquid assets they have is the $200 million of cash, and that represents about 3% of their deposits. and that's pretty scary actually. If they were to if 3% of, well, I think it would require more of a complex calculation than this, but if a pretty small amount of their deposits left, customers closed their accounts and left, um, they wouldn't have enough cash to pay them. Would maybe have to borrow more from the FHLB, and that would be more expensive and kind of eat into more of their um, more of their capital. But they do have a lot that they can borrow from the FHLB or the Federal Reserve. It's actually not a lot. As we talked about, they had a little over 3 billion borrowing capacity, but they've used up a lot of that. So there's about 1.1 billion letters of credit that they've got that used that up, and then they borrowed 250 million. So all that together, based on the loans that they've pledged, as well as the securities that they've pledged and everything. They basically pledged everything, all their securities and all their loans. Like if you were to look at the call report, you would see that basically all of their loans and all securities have been pledged to someone. So basically their total liquidity, which would be the 200 million cash, like the on-balance sheet liquidity, plus what they can borrow from the FHLB and Federal Reserve, is only about $2.4 billion, which is only about 38% of the deposits. So that's a really, really low percentage. Most banks come in the range of somewhere between 70 and 80% of total liquidity as a percentage of their deposits. So I feel like these guys could get in a pretty good bind if they had some deposit flight. And so how likely might that be that deposits might leave? And if you looked at in the call report, the amount of uninsured deposits is 45%. Which is a little on the high end. Most banks we would see somewhere between 30 and 37%. So it's a little bit on the high end of uninsured deposits, but also what we saw, they've got 1.1 billion of their letters of credit from the FHLB, and all their assets essentially pledged to that. So actually, the actual percentage of deposits that aren't insured and that don't have pledges is probably a lot lower than that 45%. But that's certainly a risk. Another thing we might look at is what's called the core deposits. So that would be deposits that aren't brokered, or that's not a CD that's greater than 250,000. So that comes to about 89%, which is pretty average. Most banks will see somewhere between 87 and 92% of their deposits being core deposits. So they've got an average amount of core deposits, so it seems like there's not that much risk for the deposits to leave, because they're the core ones are the naturally ones that are expected to kind of stick around. So I mean, if we were to look at the traditional ratios for capital adequacy, like the common equity ratio, it's almost 11%, so 10.89%, and that's higher than most banks. Most banks 9 to 10.5% common equity ratio. These guys have got almost 11%. So I feel like the equity that they have in place is adequate to not bank for the bank to not run into rough waters, whatever analogy you want to make out of that. But also, as we talked about previously, even converting everything to fair value puts them at a really good equity value relative to their assets. So I feel like the liquidity part is a little bit of a risk. Um, Especially if there were to be some deposit flight, but they have a lot of equity capital relative to what most banks do, and feel like they could um, be able to figure things out. Maybe borrow more from the FHLB or from the market in general if they needed to, which actually might come in a little bit. Well, I guess now the rates are probably a little bit higher than what was being yielded on in this quarter, but yeah. So there's certainly a risk there. So, and I think we skipped over it, or yeah. So asset liability management is kind of the interest rate risk. They don't provide us a nice explanation or a table that most banks do, so we sort of have to do our own calculation and analysis, but we use the call report for that, and so we can see the timing of when the loans reprice, when the securities reprice, when the deposits reprice, when the loans or when the debt reprices, and we can kind of create a metric for what is the interest rate risk, what's the repricing timing of everything on a net basis, and also taking into account the derivatives, which, as we saw, were cash flows hedging the cash flow hedges that are hedging the variable rate loans. So if we from looking at the call report, I can see that less than 38% of the loans reprice within the next year. So that ends up being $2.5 billion. And then 41% of them reprice within the next 5 years. So really, within the next 5 years, 79% of the loans reprice. And that's a pretty high percentage. Normally we would see somewhere between 55 and 75%. But in this case, it's 79%. So really, they've the loans being 85% of the balance sheet. Of course, that has the biggest bearing on interest rate risk, and so a lot of them reprice really quickly, and that's actually really good for the liquidity as well. Whereas before we were concerned that they've only got $200 million of cash, but they've also got $2.5 billion of loans repricing within the next year. So whether that means that they're actually maturing and being paid off, or if it's just a adjustable rate loan or something like that, we don't know. But either way, that creates a good interest rate risk, because once the loans reprice, they'll reprice at these higher rates than they were last year or the year before, and we'll be able to make some more money then. So I think that is the bottom of things. They've also got 887,000 shares that the board has authorized them to repurchase. I think that's about 3% of the shares. Yeah, so about 3% of the shares, and that will be nice. But yep, so that's the bottom of the thing. So to kind of recap things, as far as the profitability goes, I think they end up with about an average profitability. The net interest income side is a little on the lower end. So the traditional community banking side makes a little bit less than what most banks do, but they make up for that by having a whole lot more non-interest income sources, such as insurance and broker-dealer and investment advisory, that type of stuff. So they're really making a lot of money there, which adds to the bottom line. And even with those extra services, they still have a little bit less non-interest expense than most banks. So they're making a really good efficiency ratio. I don't think I mentioned that before. So 65% efficiency ratio, that's pretty much right in the middle of the range for an average bank. So really, average profitability of the bank. So let's talk a little bit about the risk of that as well. From a credit quality standpoint, I feel like they have really good credit quality. Not only is the loan portfolio pretty sound, where they've got either an average or superior or average or lower amount of past dues or non-accruals or anything like that. Not only is the portfolio sound in itself, but they also have a reserve that is way higher. Well, not way higher, but a little bit higher than what the average bank might have, given those types of loans. So I feel like they're really well reserved, and they got a little bit lower risk of later on any loans or future reserves significantly hitting the income statement, more so than the average other banks, right? So credit risk is good. Interest rate risk I also think is good. So as we talked about, most of their loans, I think 38% reprice within the next year, and almost 80% reprice within the next 5 years. So if interest rates were to go up, they have a really good setup to where they will be earning more interest income, which will be awesome. Now, from the capital standpoint, capital risk standpoint, I do think that their liquidity is a little bit low on the low end, and that's a little bit scary. But as we saw, they've got $2.5 billion of loans that reprice soon. They've basically pledged all of their assets to either depositors or to the FHLB or Federal Reserve, and so they basically have no more assets to pledge to get more borrowing capacity. So that's a little bit scary as well. But they do have more equity, either on a book value basis or on a fair value basis. They've got more equity than than the average bank does to shore up any of that liquidity. So I do think that the liquidity and capital risk is a little bit higher than the average bank, and so if you were to put a scorecard on all this, average profitability, good credit quality, good interest rate quality, less than favorable capital and liquidity. So, looking at in the context of the valuation of the company. So, as we saw, the earnings yield, I think, is over 12%, which is, far outside, well, maybe not far outside, but it's higher. It's a higher yield than what we might find for the average bank. So most banks somewhere between 9 and 11%. These guys would yield us 12% if we bought the company at these prices. So looking at the fair value of the net assets as well, I think it was a 1.15 times. So you'd be buying the net assets of the company at 1.15 times their fair value. Most banks will see somewhere between 1.5 and 2.5 times. So we would be buying the net assets of the company at a deep discount. We would also be buying their earnings at a really good yield. So whenever we think about that in the context of the risks that we have in place, we feel good about the credit quality. We feel good about the interest rate risk. Capital risk is a little bit worrisome, but we would be, I feel like we'd be compensated for it through the higher yield, getting to buy the net assets at a much cheaper rate. So I feel like the bank is at a fair price for the risks and the earnings that we're getting. So I feel like it would be a good buy. We'd be making good money, and if things were to go awry, they would have other sources to, even though the capital and liquidity might not be the best, they would have some other avenues to take to continue operating. I feel like, but it certainly is a risk, but we have the ability to buy the company at a cheaper price than we would other banks. So I feel like it's a fair deal. So that's that. That's what my thoughts on the thing. So let me know what you think. If there's anything you think that I missed or should also consider, or let me know if you agree or disagree. Love to hear what you think about it. Yeah. Thank you for listening.